I mean, there's not been that much volatility in markets. Typically, as you move through into the mid-cycle phase, you would expect to get at a higher degree of volatility. And we've had a couple of bouts of that, but it has still been relatively orderly. And so I don't think that there's been any disorderly unwind, really, for Chair Powell to feel the need to step in with either verbal intervention or thinking about changing purchases along the maturity of the curve. So to us, if you saw more of that volatility coming through, he could. But I think he's been very, very clear with his dialogue, with the dovish tone, and obviously markets are pushing back on that quite considerably. But when we look at the opportunities from here, and you know, when we think about the winners and losers that you mentioned just before I came on, you know, we've been thinking back in September, industrials, semiconductors, materials were the first ways we started to add cyclicality to portfolios, and I think all of that still stands. But the opportunities we see now amid you know, higher, longer dated yields, steeper curves, really lie with global financials. You know, US banks, European insurers would be parts to pull out there, but also the consumer. And I think this is a key catch-up trade that's going to play out over the next few months. When you look at consumer spending, pent-up demand, the fiscal stimulus that you know we know is coming in a large size out of the US, plus potentially an infrastructure bill later down the line, it's going to be the consumer and particularly the services part of consumer spending that bounces back. That services part is still 10% below pre-pandemic levels. Consumer goods spending is 20% above pre-pandemic levels, and I think you're going to see a real switch there. So for people looking to invest in laggards that still have that cyclical flavour, we would be looking at consumer pent-up demand names.